Welcome to the Bean Pod, a podcast about decentralized finance and the Beanstalk protocol. I'm your host, Rex. Before we get started, we always want to remind everyone that on this podcast, we are very optimistic about decentralized finance in general and Beanstalk in particular. With that being said, 3 things. First, always do your own research before you invest in anything, especially what we talk about here on the show. Second, while you're doing that research, try to find as many well-developed, opposing viewpoints as possible to get the best overall picture. And third, never ever invest money that you can't afford to lose or at least be without for a while. And with that, on with the show. On this special episode of the pod, we're going to be talking about one of the largest events in the history of cryptocurrency, the depegging and collapse of the Terra stablecoin system and its sister coin Luna. This week, amidst volatility in both crypto and traditional markets, Terra left its peg, and as Publius will describe, began a series of events that resulted in billions of dollars of losses for investors. We'll be talking about what happened, why it happened, how the situation relates to Beanstalk, and what the Beanstalk team has learned from watching the process play out. 2 other quick notes as we get started. First, this is the first episode being released after Publius voluntarily revealed their identities in mid-April. Because of that, you'll be hearing 2 of the 3 founders, and both speaking without voice modulators, so sorry to all of you Darth Vader fans out there. Second, and on a far more serious note, we at the pod want to extend our sympathy to those that have lost fortunes due to the Terra and Luna collapse. We've heard of a number of individuals potentially attempting suicide, and we genuinely hope that anyone listening now that's struggling will reach out for help. Professionals at organizations such as the National Suicide Prevention Hotline are available 24/7 if you're in need of someone to talk with, and their number is 1-800-273-8255. All right, we're in the studio today with 2 of the 3 founders of Beanstalk, collectively known as Publius. All right, so Publius, obviously, a lot of things going on in the crypto markets in general. Biggest story recently being Terra, Luna, for lack of a better way to put it, the falling apart or destruction of that system. Huge financial implications, lots of technical implications, a pretty complicated story. I was wondering if you would be willing to kind of just talk through a few different ideas around what happened. So what happened in general to the Terra and Luna system, what the implications were for them, what Beanstalk does to perform differently than the Terra Luna system, and what makes our system different from that, and then maybe what are some things that we've learned by watching this experience happen.
Thanks for having us back, Rex. And yes, it's been a painful week in crypto and markets at large, but particularly in crypto. And it's always unfortunate to see the dramatic loss of wealth that comes with some of these crashes, or all of these crashes. And ultimately, as you said, Rex, there's a lot of different important lessons that can be learned for anyone working on a stablecoin in general, certainly, but as it applies to Beanstalk in particular as well. So let's start with what actually happened. Let's lay the scene. The growth of UST was fueled by Anchor, as we've spoken about before. And while the core peg maintenance model, whereby you can convert UST to Luna for $1 worth of Luna when the price is too low, and vice versa, when the price is too high, you can convert $1 worth of Luna into 1 UST. That model is quite simple. It's a basic mint and burn model. And the reflexive nature of that system was particularly, and why is that system reflexive? Let's just state. So in practice, what is the ability to exchange when the price of UST is too low for $1 worth of Luna? What is the implicit assumption being made there? It's that even if there's not a bid for UST at $1, people are only willing to pay under $1, there will be some bid for Luna. And in particular, if there's not a bid for UST at $1, it doesn't matter where the bid is for Luna. It just matters that there is a bid in practice. Where if you have USD, you can either sell your UST on the market for $1 or convert it into Luna and sell your Luna for $1 worth of Luna. However, if we go into a little bit of the problem, and the problem with the model in practice was that there was a limit on how much the UST could be converted into Luna at any given point in time. And so instead of always offering that promise of you can convert one UST into $1 worth of Luna, that as soon as that threshold was reached, now the holders of UST need to make a decision as to whether they want to wait until they can convert for $1 worth of Luna, recognizing that there's an excess amount of demand to convert beyond the threshold, or sell their UST at a discount. And if we take a little bit of a step in towards the actual state of their ecosystem at the time, the vast majority of UST was in Anchor protocol and receiving a fixed yield for depositing the UST in Anchor. That yield was heavily subsidized by Luna holders. In practice, because $1 of demand for UST, someone buying one UST, created more than $1 of value for Luna holders, that created a nice incentive to subsidize the holding of UST in whatever way possible. Now, Anchor was pretty inorganic in terms of the demand for UST that it generated because the yields were subsidized and unsustainable. And so the people that were participating in the system over the past couple of months became more and more aware of that potential unsustainability of the subsidies pertaining to the yield on Anchor. And so that was what a lot of the discussion has been over the past couple months of whether the Anchor yield is actually sustainable. And the response from and we're not so in tune with the timeline of events or who actually did this, so we'll be somewhat vague so as to not be incorrect. The powers that be in their ecosystem made a couple of changes or proposed making a couple of changes at least to the structure of their market. Primarily, they were going to change the collateral backing the ecosystem to a partially Bitcoin collateralization, which is interesting because Bitcoin is decentralized. However, it signaled a very clear move away from the faith that they had in Luna to function as collateral. And so that heightened, at least in theory, would have heightened the awareness of everyone that the people running the ship are not confident in the current structure of the model. So there was a substantive change in the model where they started to collateralize the system with BTC. And then in addition to that, and they did both back to back, and that ended up creating sort of this perfect storm because the two things were happening at the time, the move to BTC collateral, and they decided to lower the Anchor yield from a fixed 20% perpetually to a variable yield. And that did change dramatically the risk return profile of the system. So you combine the two, and that basically created a potential perfect storm, which it appears that someone took advantage of. And if we start to break down what it appears actually happened, and why this led to a collapse on the system, there's a couple different parts here. The first is that the majority of peg maintenance from conversion was done by a very select few parties. And so in practice, all of the people that were in Anchor protocol, they had some sort of expectation that there was just peg maintenance being done. And they didn't even necessarily need to worry about it per se. And the concept was that this run on the bank that ended up being a massive run on the bank that still seems to be ongoing, was actually started by a small depegging of the UST price on Curve, coupled with a dumping of UST on Binance. And in short, that excess supply created enough desired conversions from UST to Luna to reach the threshold, effectively, the throttle limit. And so if we restate the state of their model, at that point you either need you need there to be bid for UST, effectively. And you need there to be bid for UST at $1. And what happened in practice was there wasn't a bid at $1 in size to recoup the UST price back to $1 without the ability to convert UST in size to Luna. And therefore, people started to get very nervous. And given the undertones that people were in general already nervous about the sustainability of the Anchor yield, there started to be large outflows from the system, from Anchor. And at the time, the deposits in Anchor relative to the total UST supply were massive. It represented well over 50%. I don't know the actual numbers, so that's why we're keeping it conservative, but a massive proportion of the total supply of UST at the time was in Anchor. And as you had these outflows from Anchor protocol, the people that were withdrawing from the protocol then had a choice of whether to sell their UST for below $1 because it was trading below $1, or to wait to convert whenever the gates were back opened, effectively. And very quickly, people started to, en masse, decide to take the former option and sell their UST at a steeper and steeper discount. And thus began the run on UST. And of note, because you have this convertibility throttle that was limited, there was this expectation of infinite future supply on Luna. And there wasn't an opportunity for the market to quickly clear that UST supply into Luna supply. And instead, there was an opportunity for the Luna market to clear in expectation of all of this UST supply to clear. And so that throttle limit in practice ended up being very helpful and protective to the Luna holders at the cost of the UST holders. And so in practice, simultaneously, you had the collapse of the UST price with the beginning of the collapse of the Luna price. And given the expected amount of outflows from Anchor that started to build up that needed to either be sold at a discount or converted to Luna, there ended up being a huge run on the Luna price as well. And the only uncertain piece here is what happened to the Bitcoin collateral that they started to accumulate. And that remains unclear at this moment because of the opacity of the process surrounding that mechanism. And that contributes to how people just had faith in that the system was working and very quickly lost faith. So then once you had a large series of outflows from the Luna market and that started to crash, the attraction of holding UST became less and less attractive, and therefore that price started to collapse further, and thus began the death spiral that we've seen over the past couple of days. So that has played out in rapid fashion, in rapid speed, and it was all really started by one small run on the bank. And you could make the argument that it wasn't the small run on the bank, it was actually the state of the protocol prior to the economic attack, if you want to brand it that way, or just the state function, the system functioning normally, because in theory you should be able to accept a decentralized stablecoin should be able to accept arbitrary amounts of supply and demand and react to it. And the amount of UST that was sold on the market to start this bank run was very small in comparison to the total supply of UST, and that goes to show the fragility of the system in practice. So that's sort of what happened as we understand it. There did seem to be a more sophisticated economic trade that somebody made to try to profit off of setting this up and starting the bank run. That is a fascinating thing to look at, but perhaps not the most relevant for this discussion. To us, there's really a couple different things to talk about at this point. One is, what are the differences between Beanstalk and a system like Luna or Terra? And maybe even more high level, is a stable coin, is this possible? Is it possible to create a non-collateralized stable coin? And in practice, UST was collateralized by Luna, which was a reflexive collateral, which helped exacerbate this run on the bank. But the question is it possible to have a system that's resilient to run on banks and doesn't prevent runs on banks, but instead limits them and makes it inefficient for people to participate in the run on the bank? And that is the more interesting question to us. So many different ways to take it. Publius, did you have anything you wanted to add on what happened to Terra and Luna over the past couple of days, or feel free to comment on anything we've said thus far?
Yeah, I think you did a very good job there on kind of giving a good overview of the situation and what happened, and how we kind of ended up in this place we're in. Kind of would love to touch a little bit more on what you said in regards to, kind of the system assumes that there's always going to be a bid for Luna. So the question becomes like, is there going to be always going to be a bid for Luna? And, currently, is there a bid for Luna? And, kind of why is the price continuing to just kind of fly downward? Does that mean that there will eventually not be a bid? Will the price just converge to zero? And thinking about it, right, you look at the number of Luna that's minted per each UST burned. When you burn a UST, you get a dollar equivalent of Luna. So if Luna is, 1 cent for each UST you burn, you get 100 Luna. If Luna is $1 for each UST you burn, you get 1 Luna. So the lower the price of that Luna goes, the more Luna is burned. And essentially what you're seeing right now is, the current Luna supply is, I think it's around 50 billion at this point. And kind of what's happening is, the Luna price continues to go downward. And as more UST is burned to mint Luna, the total supply of Luna just increases even more because the price of Luna is lower. And that just causes kind of an exponential amount of buy pressure as the Luna price is dropping, the amount of Luna that's, being minted and sold is increasing. So if you're someone who's looking to take the other side of the Luna bet, you either have to be able to somehow buy the price of Luna back up. So to stop this, huge amount of, supply expansion, or you have to be willing to kind of fight, an upward battle of an ever increasing supply of Luna being minted. Now, if you are that participant that, wants to take a hold of Luna and wants to kind of help stabilize the price, it's not looking like a great bet for you right now because, you stabilize the price. There's still going to be billions and billions of more Luna minted. And this is kind of where the incentive system breaks down a little bit, to where you look at how Bean responds in a similar situation, right? Bean kind of relies on the fact that there's always going to be a bid for someone to, buy pods, to buy the price back up. And you look at kind of how the incentive structure around, sowing beans into pod is versus the incentive structure around accumulating Luna. And, kind of with pods, bean crashes to 20 cents, right? You have this weather, and the weather is the exact same it was at PEG. So to the system, it's still willing to issue the same amount of pods, but you're now able to get that at an 80% discount because you're buying that bean at 20 cents and the weather is the same. So, kind of where we're seeing with Luna, the Luna price drops and instantly more and more Luna is being created and, minted just, and sold. And it's kind of happens really quickly, really fast. On the bean side of things, bean drops to 20%. Instead of having all of this, kind of sell pressure coming from Luna and crashing the, kind of reflexive collateral, we actually just have this weather that slowly starts to increment. And, it starts where it is. Let's say it's at 5,000. It increments 3% a season, assuming no one's willing to buy that, kind of sow that soil. And it's a lot more stable in the fact that it takes some time for the weather to increase. It's not just going to infinitely go to infinity and we're just going to see, the pod rate go to infinity. And so it's a lot more kind of stable in the fact that it doesn't just quickly, if you're the person who's sowing beans, there is an incentive to sow now. And, with the Luna thing, it's like, do you hold the Luna peg now or do you let it go to zero? And it's like, if you let it go to zero, you're going to get a lot more Luna and a lot more cheaper price. On the bead side of things, if you sow beans now, you're going to guarantee your place in the pod line. And sure, the weather might increase. And tomorrow you might be able to get a better deal in the sense that pods are technically cheaper. But now you'll be able to secure your spot in when you are redeemed. And so, it kind of helps to alleviate the downside of that kind of problem with the Luna price just kind of tumbling down to zero.
Agree with everything you just said there, Publius, and would add on to it. And we're starting to get into how Beanstalk's model differs substantively, and you hinted or got at one of the most substantive points. But you asked a great question, which was somewhat rhetorical. Is there a bid for Luna? And right now the answer seems to be no. But the question is, why isn't there a bid for Luna? It's because everyone understands that there's a massive inflow of Luna supply coming because of this UST overhang, as you just explained. And so the efficient behavior is not to buy Luna, instead to wait until it goes much lower and all of this sell pressure clears. And the price may go to zero before that. Whereas, and that's where the reflexivity comes in. The collateral backing the system, the value of the collateral tends to disappear at the exact same time that the system needs the value of the collateral most. And that's where this reflexivity has really become the death sentence for their ecosystem. However, as Publius, you were saying, in Beanstalk, the key difference here is the fact that debt isn't fungible. The collateral, if you want to think of it that way, even though it's not collateral in any capacity, but the asset class backing the system, the lenders that are providing that bid for beans, if you will, when there is excess supply, they are incentivized to bid for beans, not for Luna, but bid for beans as soon as possible. And that is because of the first in, first out harvest schedule of pods that you were talking about. And in practice, the game theory around the behavior, the efficient behavior for what to do when there's a bank run. Because again, it's really important to state again and again, Beanstalk cannot prevent a bank run. It doesn't make any attempts to prevent a bank run. If people want to sell their beans in mass for whatever reason, so be it. However, what the system is designed to do is to limit the growth of the bank runs further, and to make it such that at some point the bank runs will stop and the system will return to an equilibrium at $1. And that is substantively different from the reflexive nature of the Terra ecosystem, whereby once you enter these bank runs, there is no anti-reflexivity native to the ecosystem from an economics perspective, because as Publius was describing, the efficient behavior right now to do is to let the Luna price continue to crash and buy it lower, because you have this expectation of infinite inflation in the short term. So in the case of Beanstalk, the fact that the interest rate isn't going up very quickly, however, you have this first in, first out harvest schedule, combined with the fact that the only way to participate in the pods is to hold beans. So there's two potential people here, right? There's the people that are considering having the run on the bank, and there is something to be said for maybe the capital has already left the silo. We'll talk about, I'm sure, the incentives to stay in the silo and not leave the bank at any time or when the bank run is happening. But let's say that this is a liquid bean holder that may sell their beans or lend their beans to the protocol. This first in, first out incentive structure is very powerful in the sense that they can sell their beans at a discount or they can lend their beans to the protocol for the weather. Then you have the other side of the market. You have the people that are interested in buying the beans. And as you were describing, buying the beans at 25 cents or at 20 cents adds a multiplier on top of the weather. So if the weather is a 50x and you're buying the beans at 20 cents, that's another 5x. You're actually getting a 250x in terms of your dollars spent towards pods received. And that's the nature of the anti-reflexivity of the system. As the price goes lower, the real multiple on capital for participating and lending to the system increases dramatically the lower the price goes. And that primarily affects the bid of the system, such that as the price gets lower and lower, the risk-return profile of placing that bid gets more and more attractive, not less and less attractive. And that's really where the primary anti-reflexivity comes from a model perspective. It is this first in, first out harvest schedule and the incentive structure that comes from having debt not be pari passu, having no collateral be pari passu or treated as equal as is the case of Luna, but instead have this first in, first out mechanism where people are incentivized for catching the knife during a bank run and getting in line faster because that will ensure that they get paid back faster on their interest. And when we're talking about a 50x return times 5, there's obviously significant risk associated with any potential 250x return. Goes without saying. But the main point here is the return goes up dramatically as the system enters a bank run. Whereas if you look at the risk return profile of Luna right now, that is not the case. The efficient thing to do is to let the system play out because there's no incentive to being the bid right now. If you're a bid right now, that definitely is inefficient behavior from an individual perspective. So that may be what the system wants you to do, but it's inefficient to actually do. Whereas the first in, first out harvest schedule really does create that behavioral incentive to act. And that's the core mechanism. Beanstalk is a credit-based system, is this lending model. And so that's the first thing that needs to be focused on. But as we kind of work through how Beanstalk works, there's a couple other pieces. There's two other main pieces, we would say. One is the stock system, and two is convert, that really work hand in hand with the lending structure to create an anti-fragile system. So maybe before, go ahead, Publius.
Yeah. So I guess before we go on, one more point wanted to amend on there. Kind of we talked about how, buying and sowing beans at 20 cents multiplies your return by 5x. Now, in the core Luna model, that is technically still true for UST. In the UST model, if UST is 20 cents, you should theoretically be able to redeem that UST for $1 of Luna and be able to sell for a 5x in a similar structure that we described with sowing your beans. So the question is, why aren't we seeing that in practice? If UST is 20 cents, why aren't people buying that, converting that at $1? And this goes back to what Publius was saying about, first off, the throttle limit. It kind of is akin to what we were seeing with ESD, to where there is no first in, first out model. Kind of with ESD, there was the problem of if you buy debt, there's no promise on when you'll be able to redeem your debt. You can be the first person to buy debt and be the last person to be able to redeem it, because there's no guarantee that when you buy your debt of when you'll be able to redeem it. And we're seeing a similar thing with UST here. Because of the throttle, if you were to buy UST at 20 cents, you would be competing with all the bots in the system to be able to redeem that at some point. And that kind of makes it a much more risky bet, because you're buying UST and that's only the first half of the battle. The second half of the battle is competing to redeem that into Luna. And then the second side of the coin is, kind of the bid for Luna we've talked about. If you buy UST at 20 cents, you have to then fight to basically be able to redeem that Luna or UST into Luna. And then you have to be able to sell that Luna. And given the price of Luna is just spiraling downwards, the market seems to be saying that they don't think that the price of Luna is going to be, greater than 20% of its current price by the time you're able to buy UST, redeem it, and sell it. So kind of
not even 20% of its current price, but just 20% of the price that you'll get whenever you can redeem it, which more reflects, in my opinion, the fact that there's an expectation you'll never be able to actually convert. You'll just be throttle limited in perpetuity until Luna is worthless. And this really is a great point that you highlighted, Publius, which is that Beanstalk, because of the first in, first out harvest schedule, allows people to lock in their price, lock in their return. It's a one-step thing. You understand exactly what implied future market cap or future supply you will be paid back at, and you can lock it in. And there's no second step. There's no additional risk thereafter of whether you'll actually get paid back, whether people will cut you in line in the case of ESD, whether you'll need to convert in the case of UST. So you're totally right. This is a key point that from a decision-making perspective, people can actually price the risk. People can say, okay, there's a risk I lose all my capital and never get paid back. There is obviously a secondary market for pots, which has been a game changer for the ecosystem. But from a lending perspective, you may never get your capital back. But if you do, you know exactly what your return will be. Whereas in the case of UST, this ambiguity as to whether you'll ever be able to convert and convert to Luna, and when you do, whether there will be a bid on Luna whatsoever, that is what creates the additional friction. And it's certainly a friction that was evident in ESD as well. Very good point.
Yeah, was just going to say, I feel like we've kind of explored, I guess, Publius, anything else you want to say in regards to specifically the core peg maintenance mechanism of Beanstalk versus Terra, and kind of the conversion model versus the debt model?
So the other thing that's important to note, and this does relate to now talking about the other side of the Beanstalk market, which is the silo, the DAO, the stock system, is that the ecosystem in a mint and burn system like Terra is such that all of the upside for holding the currency goes to the speculators, goes to the Luna holders. And there's very little protocol native utility for holding the stablecoin itself. And if we think about how, in theory, there's nothing perhaps that would cause this type of run on the bank in their system if all of the demand for their ecosystem and for UST was truly organic and the result of high product market fit and stickiness, you may not have a run on the bank. But the reality is that all of the demand for UST, or the vast majority of it, was in Anchor protocol, which had no native stickiness whatsoever and no incentives built in to stay whenever you had a depegging event. And in fact, the fixed APY made it very easy to price, well, what is my expected sell price on UST compared to my expected yield that I'm receiving? And the fact that UST was depegging aggressively changed the calculus very easily for people to say, yeah, got to get out of here as quick as possible because the future upside for staying is not great enough. And this is where the silo, and we do give ESD a lot of credit because they facilitated the deposit of the stablecoin in the DAO, but there was no stickiness that they had. So whenever the price was below $1, whenever you enter these runs on the bank scenarios, if you will, or even not a run on the bank, but just that there was no seniorage, it tended to create a run on the bank because there was no incentive to stay deposited in the DAO. And so Beanstalk uses the stock system to create a highly sticky effect on user behavior to refrain from participating in bank runs. So in practice, how does it work? When you deposit assets in the silo, and you can deposit beans or LP tokens, you receive stock and you receive seeds. Stock is the governance token and entitles you to participate in voting, and it also entitles you to a portion of bean seniorage. So anytime the bean supply increases, a portion of the bean supply goes to paying off debt, and a portion of the bean supply goes to paying stockholders. Prior to the attack, it was 50-50. After the attack, it will be a third to old pod holders, a third to the new lenders that participated in this private, or the recapitalization, we should say, and then a third to stockholders. But the concept is just for holding beans or holding LP tokens that beans trade in, you receive stock, which entitles you to seniorage. And the seeds that you receive upon deposit yield more stock over time in a linear fashion. And so individually, there's an incentive structure where whenever you withdraw your assets from the silo, if you're participating in a run on the bank or you're just withdrawing your assets in any normal case scenario for whatever reason, you have to forfeit all of the stock, seeds, and stock that has grown from seeds associated with the deposit. And that creates an opportunity cost around the behavior of withdrawing from the silo and then redepositing your assets again at some point in the future because of all of the grown stock that you have to forfeit, which you've received for staying deposited. And the opportunity cost increases the longer an asset has been deposited in the silo. Now, there is this individual incentive that has shown in the market to minimize people's participation in bank runs, but it's really important to get into at the margin how at its current scale it probably doesn't have this effect, but at a much larger scale, particularly in a market where there's liquidity for stock, you would see this additional layer of anti-reflexivity play out, which is the benefit your grown stock, the stock that you've received for being deposited in the silo or having assets deposited in the silo for a longer period of time, that opportunity cost can be evaluated in terms of opportunity cost relative to others for withdrawing. And so the grown stock that you have relative to the total grown stock, meaning your bonus compared to everyone else's bonus, increases as people start to leave the silo, because people start to forfeit all of their grown stock, all of their bonus, and therefore your bonus relative to everyone else's bonus or new participants in the system increases. And so the concept is at the individual level, as other people start to exit the system, the stock system creates an incredibly sticky economic incentive to stay and to not withdraw your assets and participate in the bank run. And we'll get into convert and how convert facilitates the participation of peg maintenance from these DAO members. But just before we even get to convert and all of that, think that the core, because convert was introduced after Beanstalk was launched, so I think it kind of makes sense to talk about that after. But just from a core mechanism design, feel like the lending and first in, first out harvest schedule we discussed and the stock system are the two primary pieces of the stability model that were a part of Beanstalk prior to its deployment or at the time of deployment, and then convert would be the one that was added after that. So Publius, do you have anything you wanted to add on the stock system?
Yeah, nothing specifically. At the beginning, you highlighted that ESD did not have any sort of long-term stock incentive, but, think it should also be mentioned that Anchor did not either. If Anchor somehow had baked in some kind of, long-term incentive to stay in during bank runs, who knows? Maybe the magnitude of the sell-off from Anchor might not have been as much. You look at the Anchor deposits, right? It kind of maxed out at around, 14 billion UST and instantly just spiked downward. If we were seeing a case where long-term participants were, maybe a little bit more wary to withdraw because of, kind of the long-term, some opportunity costs that they've gained from being a long-term participant, we might not see as much of, a withdraw and sell-off as we did. And, kind of going back to the ESD bank run, this is exactly what we saw. ESD, the price goes below 1, you're not going to withdraw. Why would you stay deposited? So, kind of that is what was sought to be solved with the stock system. Also want to talk a little bit, maybe taking a further step back and, touching a little more on you discussed as why UST or in Terra needed Anchor at all. And, why they needed a 20% fixed rate interest for their stablecoin. And it goes back to some points Publius brought up as we were discussing the peg maintenance mechanisms, is that, you receive no upside from being a UST holder in the supply of UST. And when you go look at other stablecoins out there, like Frax and, an under collateralized model that's still very collateralized, DAI, MIM, Liquidity, Alchemix, these collateralized stablecoins, they all kind of max out at a supply limit. DAI has had a very hard time pushing above, I think their max was like 9 billion, but, their supply is always going up and down. Frax is kind of stuck at, believe it's somewhere between 2 and 3 billion. MIM is also kind of stuck between 1 to 2 billion. And the problem is, it's easy to scale up to, around a billion or so, and in that kind of billions range. But to go to the next level, you truly need some utility in order to just pump the supply up, get more people holding the supply. And Anchor was Terra's solution to this. being an uncollateralized model, they didn't need to attract more collateral, which, would argue that if there is a sufficient enough yield to be made, you could potentially attract more collateral. But, they needed someone to be actually holding the UST and doing something with it. And their solution was Anchor, this, completely unnatural system that creates artificial demand and is subsidized, by the holders of Luna.
And in particular, the thing to note here is that growth was highly unsustainable in the sense that the demand for Anchor, to put UST in Anchor, didn't increase the sustainability of the system in any way, meaning the liquidity in the system didn't necessarily scale for UST or for Luna, along with the demand for UST to sit in Anchor doing nothing, right? So you had all of this UST effectively collecting dust that when it all wanted to run for the exits, there was no liquidity to match it with. And this was largely because Anchor was not product market fit. It was heavily subsidized. And so, as Publius said, while it facilitated the growth of the ecosystem to higher peaks, it also facilitated a much quicker unwinding of the system because there was no reason to stay deposited in Anchor. And the thought of how to add stickiness to Anchor is certainly, that might have had some effect. Unclear given all of the other problems whether that would have been enough, but obviously lots of different places for improvement. So the other thing to talk about that this lends naturally to is, well, how does liquidity for beans scale as the supply grows? And this is where convert comes into play. And in addition to the stickiness of the stock system and the natural anti-reflexivity of the lending system because of the first in, first out harvest schedule, the convert functionality that was introduced in BIP 7 is probably the most powerful tool to stop bank runs in a shorter period of time. Meaning the first in, first out harvest schedule and the soil system, the lending model, all of that is more of a long-term response. It's a slow-moving system. The weather doesn't increase particularly fast, as Publius was saying. And so if the market needs the interest rate to increase dramatically to clear all the soil, so be it. And similarly, the stock system, while during a bank run it does have that nice anti-reflexivity that we mentioned, the effectiveness of the stickiness really builds up over time. And the longer assets are deposited in the silo, the more meaningful the stickiness. As opposed to convert, it's kind of your hard and dirty bank run resistance. And so first let's state, what is convert? Convert is the ability for depositors in the silo that have deposited beans or deposited LP tokens to participate directly in peg maintenance and maximize their yield in doing so. So when the price of a bean is too high, any bean depositor can convert their deposited beans to deposited LP tokens without a loss of stock, in particular the grown stock. So there's no opportunity cost associated with selling your beans when they're above $1. And so in essence, Beanstalk incentivizes people to sell their beans when the price is too high, but not just sell their beans, sell them into liquidity and then provide liquidity to the system. And then vice versa, when the price is too low, Beanstalk offers similar incentives to convert, meaning no loss of grown stock, for converting your deposited LP tokens into deposited beans when the price is too low. And just as a caveat, we would note there is one potential friction point here where under the current rules, there is a potential loss of stock when converting from LP to beans if the bean denominated value of the LP position has changed, but think that that's something that via a BIP can be changed to minimize such that there's no friction on downside converts whatsoever. But nonetheless, the ability to convert from LP to beans has in practice been highly efficient at reducing downside volatility to a large extent. Now, how does that work in practice? Well, the concept is that if you have beans trading too low on an exchange, on a DEX, in an AMM, what that really means is that there's too many beans in the pool relative to the non-bean liquidity. And so convert when the price is too low is just the ability for the people that have the LP tokens that are in part beans, that are overweight beans, to just remove the bean portion that's overweighted and leave them as deposited beans in the silo. And so the concept is that when you have a bank run, certainly the price may go below $1, as we've said, and we'll say many times again. If people want to sell their beans below $1, so be it. There's nothing anyone can do to stop them. But the concept is people should be incentivized to buy their beans below $1 to maximize their stock returns effectively and maximize their future yield. So certainly there's always this question of should I run for the exit? Should I participate in this bank run? Should I leave? But if you're going to stay, Beanstalk offers all of these different incentives to maximize your yield for staying. And that the convert functionality has been really, it's hard to understate the importance of it to Beanstalk's success since it was implemented in December. It's dramatically reduced upside and downside volatility in the ecosystem, but more importantly has contributed to the quick rise in the liquidity to supply ratio as the bean supply has increased. And what that means is even though there's more demand for beans and the bean supply has started to grow faster and faster and faster, the liquidity trading against beans, the depth of liquidity, is growing significantly faster than the bean supply. So the system is getting more liquid, not less liquid relative to the bean supply as it starts to grow. And that we would point to as a real proof of concept in terms of potential longer term sustainability where in theory you would say, well, there's a limit of one, right? Each bean can only trade at $1 at least of a maximum of one non-bean value of liquidity in the pools, assuming that all of the assets in the silo and all the beans that are liquid are in LP tokens. And that's the kind of the limit. However, if you introduce stock into the ecosystem, liquid stock, and now you have stock trading against ETH or another asset as well, the concept is you can actually have more liquidity in the system than beans to sell. So there is a way to break through that 100% limit such that the system can be scaling down its liquidity in a variety of different ways as the system deleverages. And if we go back to how people will be burning their stock during a bank run and the stock supply will decrease dramatically, you can think that if there's a significant amount of non-Beanstalk native liquidity trading against stock, the decrease in value of stock or the decrease in supply of stock, will do something to counter the decrease in value of stock and the decrease in value of beans. So another potential layer of anti-reflexivity is introduced there whenever stock goes liquid. And this is all due to the convert functionality within the silo, whereby people can take their deposited assets and turn them into LP tokens when take their deposited beans and convert them when the price is too high, and then when the price is too low, do the reverse to maintain the price at its peg, buy the beans too low, sell them too high, and you can see how this is yield maximization behavior for users that believe in the long-term success of the system to participate in.
So Publius gave a great overview of convert there. So now to kind of take that and compare it to what we're getting with Anchor. From a system health perspective, how is Anchor impacting the UST, the peg health and stability in the long run? So with UST, what happens? People take Luna, they burn that Luna for UST, and they deposit that UST into Anchor. How is the health of the UST peg changed because of that? The UST supply has gone up, and that's about it. The Luna price has also gone up. And now the question becomes, what is that UST to, kind of the UST peg? Is that positive? Is that negative? And is that a risk? And to kind of quantify that, kind of so long as that UST can then go redeem itself for $1 of Luna, and that's guaranteed, that extra supply is not necessarily a problem. However, as we've seen with the Luna model in the past few days, there are instances where in extreme stress tests like bank runs, that you can no longer take that UST and get a guaranteed $1 value of Luna that you can then sell. And so what Anchor has, all it's doing is, instead of helping to contribute to a long-term sustainable system for UST, it's just maximizing supply. People are just burning more and more UST. The Luna price is going up. Great. This is all fantastic, right? Until we look at how Anchor reacts on the downside. When Luna's going down, when the UST supply is going down, we're seeing this extreme net supply, this positive net supply sitting in Anchor that has nowhere to go. It can't be redeemed for Luna because of the throttle limits, because of the fact that the Luna price is crashing. So the only thing you can do is sell it, and you're selling it at a loss. And now there's basically all this extra UST out there that's unable to leave the system in a sustainable way. And now compare that to the convert system that Publius just described. The convert system is always willing to increase its liquidity in exchange for less future bean mints, right? Let's say bean is $100 above, 100 beans above the peg. It's willing to take the extra 100 beans of liquidity, meaning, sell that and add liquidity with it, which would, I guess, be 200 beans.
Allow someone to do that. No,
allow
the
someone
protocol
to do
doesn't
that.
do it, but it allows.
Totally. But it's always willing to let someone do that, to where now Beanstalk will not mint those extra 100 beans, but instead it will have, 100 beans and 100 of some other non-bean asset in the liquidity pool. So it's built to optimize around a healthy equilibrium of liquidity and supply. It's always willing to sacrifice supply for liquidity, assuming there's a user willing to take that side of the bet. And that's also an important fact, and thank you, Publius, for that clarification there, is that, if there isn't a farmer out there who wants to take that side of the liquidity bet, they don't have to, and that's okay.
And that would be the case where now you have excess demand, right? No one's willing to sell their beans. The price is too high, and that's when minting really happens. And so then the new seniorage is getting distributed to all the stockholders, and people then continuously can sell their new beans into LP within the silo. And so this creates a very liquid growth mechanism, right? Where the growth of beans directly translates into liquidity, and the bean supply only grows when there's no desire to sell beans into liquidity.
Yeah, and just would say there's also this effect to where, let's say we have a group of individuals who have been converting their beans over time, right? And now one of those individuals wants to exit, right? They exit and they have liquidity. Half of what they're withdrawing is already sold. They've already converted those earned beans into some non-bean asset. And so the sell pressure from the individual leaving the system is only half of what it could have been if there was no convert functionality, meaning they were just accruing more and more beans. They're going to have to sell their entire position when they exit. But now they only have to sell half their position. Whereas there's, maybe a, complementary individual who, when that individual leaves the system, is willing to take their LP position and convert back to beans. And so they kind of counteract each other to where long-term participants have that LP to buy back, exiting supply from, kind of participants leaving the system. And participants leaving the system don't have to sell 100% of their position, as they've already sold half of it in, entering a liquidity position instead of a bean position.
Correct. Whereas all of the UST that flowed out of Anchor was straight UST, and it was selling into very limited liquidity. Exactly right. So it is important to acknowledge, though, even if the liquidity is at the limit of 100%, if you could have people that convert their LP into beans and return the peg, but if those people start to lose faith, that's when you can start to have potentially a larger depegging, if that makes sense. The original with downside converters, they start to leave the system. That's when things start to get a little bit more of a tight crunch, and then you'd expect the lending model to take center stage. So at a high level, there is obviously, when you get into these bank run scenarios, the obvious potential for further cascading scenarios where people sell, but people leave the system and sell. But the concept is, from multiple different levels, the sell pressure and the nature of the sell pressure is designed to be as minimally effective to the health of the system as possible as a result of the convert. So if the system has 10 billion beans in the supply trading against 10 billion non-beans of value, it's at that 100% limit. And now you have a billion or 2 billion beans sold on the market. The system can just due to convert, the system can just reorient itself where now it has 2 billion beans in the silo and then 8 billion beans trading against $8 billion of liquidity in the silo. So now you have additional beans. Again, if those people that were converting, they start to sell and leave the system, that's where you do get into a more insidious negative feedback loop. But as long as there's demand to convert, the system should be able to sustain itself. So there's lots of different layers to how Beanstalk ultimately responds. I think that it is really important to note, as we've been talking for almost an hour now about how Beanstalk does respond in these types of scenarios, that there is no silver bullet here. And there is no guarantee ever that the system will be sustainable. You don't really necessarily get to that point where it's like, oh, this is safe no matter what. Instead, Beanstalk is designed to regularly oscillate the bean price above and below $1. It's always going to be too high and too low. That's how it's supposed to work. And so the real question is just, what is the time between oscillations look like? How long between when it goes too high does it decrease below peg, and when it goes too low, how long until it goes back up? And then the second question is, what does the volatility look like on the downside and on the upside, and how much does the bean price actually change relative to its peg price? And in short, Beanstalk doesn't really care about either. Instead, it's designed to incentivize users to recognize that if the price is going to increase and decrease above and below peg again and again, as more of the users have faith that buying below the peg and selling above the peg is the efficient behavior, that should over time decrease the oscillations and the volatility of the oscillations and increase the speed between oscillations, or decrease the time between oscillations, maybe is a better way to say it. So Beanstalk makes no promises about stability. It, if anything, is highly likely to sustain very volatile periods of time in its future. That kind of goes without saying, being a non-collateralized system. However, and it is a big however, the concept is that if the incentives are sufficiently aligned for individual participants such that you can minimize the extent of the bank runs and stop them at some point and get people to lend to the protocol at some price, the protocol should be able to return the bean price to its peg at some point. And the more that it does it, the more frequently it does it, the more times over longer periods of time that it does it, the more likely it is that people are going to be comfortable buying low and selling high, and that is going to decrease over longer periods of time the volatility. And that's important. It's important that people that are participating in Beanstalk recognize it's not actually like a hard peg system of stability. Instead, it's a system that is long pegs to stability and is designed to minimize volatility as much as possible, but in fact welcomes it to a large extent.
Completely. That's a great point. And I guess, one final attestation on the convert side of things is, kind of Publius was talking to the potential of, converters converting LP into beans and then selling. We have been very reserved, and the whole bean community is about kind of, deciding what the incentives are to convert on the downside. And, to something Publius brought up earlier, currently there are situations where you would actually lose stock on that convert up, and that we're considering changing. But, we don't want convert to be incentivized enough on the downside to the point where it's always an advantageous position to be converting, because that's what causes those people who don't understand why convert matters to start converting. And we get into that case where people convert on the downside because they think it's strictly beneficial, because the incentives are aligned for people to instantly convert and then just withdraw and sell, which is not necessarily the system we want. We want people who are concerned about those.
Why? But let's say why. It's because if you make it such that as soon as the price is below 1, people are incentivized, the system will pay you to buy it back instantly. that imposes a higher cost to the system relative to allowing people to sell at 95 cents, sell at 80 cents. So when you have these runs on the bank, the question is, what is the extent of the incentives that need to be offered, such that maybe people buy at 99 cents and convert, maybe people convert at 80 cents, right? So if the protocol is going to pay you infinitely amounts of money to convert in all cases, that may not be advantageous, because then that becomes a lot more gameable. I think that's the main point.
Completely. And, it goes back to the point we always bring up. If X happens and you say you'll do Y, it can be manipulated by swing traders. And the idea being that, it's unclear. Each silo depositor, stockholder, has their own kind of profile of when they are comfortable converting, and maybe they're not comfortable converting at all. Maybe their strategy is to withdraw when a certain price hits, withdraw their liquidity. And that is kind of the point of how we create this convert system that is not necessarily as gameable or as manipulatable as other systems have been. And I guess, kind of one final point to say on this is, I was listening to a Bankless interview with Vitalik, and, they basically asked him about the stablecoin fiasco. And he said, anyone can hire a market maker up to a certain size. And a market maker, with significant enough liquidity can maintain the peg of a stablecoin. And, with Beanstalk, we're trying to solve that problem of creating a stablecoin, that is uncollateralized and doesn't require some larger, some large capital, some large funds or whatever to be the main maintainers of the peg, arbitraging it on the upside and downside. We're trying to create an incentivized system for everyone who is a stakeholder in the system to be actively participating together in helping to maintain the peg, as it's in their best interest, and they're actively getting yield and benefiting from that. They're the people who are maintaining the peg and benefiting from the peg being maintained, as aside from a bunch of people just holding the token and other parties who are just large stakeholders participating in peg maintenance. You look at the case with UST, right? When UST was below 1, say there's a large market maker out there, they buy, and what is the upside to that buy? The only upside is if they're able to consequently sell above 1 and make a profit, or if they have some stake in the system such that they're incentivized to maintain long-term health. That's capital inefficient, because these people have to hold some stake in the system and have additional capital to help participate in peg maintenance, right? And that requires double the capital, because, you need a significant enough stake to be willing to put up, some amount of capital to participate in peg maintenance. And to be willing to put up more capital in peg maintenance requires you to have an even larger stake. With Beanstalk, the capital you use to participate in peg maintenance is your stake. They're the same thing. By having a stake in the system, you're able to participate in peg maintenance. And to us, that is what is more capital efficient, and why we think Beanstalk has the potential to behave a lot better in the case of a large bank run, and potentially has the potential to be resilient over a long term.
Well, that's fantastic information and insight. Thank you so much, Publius.
Our pleasure.
Thank you, Rex, as always.